At 2 p.m. on June 17th, the Fed released one document, and within minutes, bond traders were moving money like the building was on fire. The 2-year Treasury yield jumped more than 16 basis points in a single day. The biggest Fed day move since 2008. Stocks fell, the dollar spiked. So what was in that document that caused all of that? Nothing. That's exactly the point. The statement that usually runs 300 words or more, the one that tells markets what the Fed is thinking, what it might do next, got cut down to about 130 words. The hints, the guidance, the roadmap Wall Street had leaned on for almost 20 years, gone, on purpose. By the end of this video, you'll understand exactly why the Fed just went quiet, and why your mortgage rate and your 401k just started behaving in two completely different ways than they used to. Let's get into it. I've watched Fed chairs change their communication style before. I've never seen one do it this abruptly. Here's where we are. Kevin Warsh was sworn in as Fed Chair on May 22nd. His very first meeting running the show, June 16th and 17th. And the vote on that meeting? 12-0, unanimous. Compare that to April, under the previous chair, when the committee split 8-4. That's not a small detail. That's a room full of people who, a few months ago, couldn't agree, suddenly agreeing on everything. Now, I'm not here to tell you what to buy, what to sell, or what to do with your 401k. I'm going to show you the mechanism, what actually changed in that room, and why it's already showing up in your mortgage rate and your retirement account in two very different ways. Because this isn't a one-meeting story. It's a new playbook. Now, to understand why this matters to your money, you need to see exactly what changed in that room, and it's not what you'd expect. Now, if you watched the video I did on this channel about who actually controls your mortgage rate, the one where I walked through the Fed funds rate, the 10-year Treasury, and that whole chain, keep that chain in mind here. Because what changed in June doesn't break that chain, it changes the signal running through it. For almost 20 years, the Fed didn't just set rates. It told you where rates were probably headed. Economists call this forward guidance. Think of it like a weather forecast. The old Fed would say things like, rates will stay low for an extended period, or at least through mid-2013. Back in 2022, it was even more specific than that. Officials said outright that 50 basis point hikes were on the table at the next couple of meetings. That's not a hint. That's practically a memo telling you what's coming, and markets loved it. They could plan around it, price it in, adjust their bets months in advance. The new Fed doesn't do that anymore. No forecast, no roadmap, just here's what we're seeing right now, and here's what we did about it. It's the difference between checking a 5-day forecast before you leave the house and just stepping outside to see if you need an umbrella. Now, here's something worth putting in context. This isn't the first time the Fed has talked this way. Go back to the Greenspan era, the 80s and 90s, and the Fed was famous for being deliberately vague. Greenspan himself used to joke that if you thought you understood what he said, he probably misspoke. It was the Bernanke, Yellen, and Powell years that turned the Fed into an open book. Detailed statements, press conferences, dot plots, the whole roadmap. What Warsh is doing isn't inventing something new. He's walking the Fed back toward that older, quieter style. And he's been very direct about why. He's said, more or less, that when markets spend all their time reacting to what the Fed might say next, the Fed ends up just hearing its own voice echoed back. No real information, just an echo chamber. There's a moment I liked from one of his interviews. Someone asked him to explain all this in plain terms, like he was talking to a regular person buying milk at the grocery store. And his answer essentially was, I can't fine-tune the price of milk, or eggs, or gas. Nobody at the Fed can. What we can do is make sure a spike in one thing doesn't spread into everything. Here's where it gets interesting. Every quarter, Fed officials submit a projection, a dot, for where they think rates will end the year. The median dot just jumped from 3.4% in March to 3.8% in June. And Warsh himself? He didn't submit one. The chairman, declining to give his own forecast. He said the other dots should be read like they were written in pencil, with a very big eraser. Because things are moving fast enough that nobody wants to be locked into a number from 6 weeks ago. So that's the shift, in plain terms. Less roadmap, more, we'll tell you when we get there. And markets, which had spent 2 decades leaning on that roadmap, did not love finding out it was gone. But here's the thing. This isn't just a communication style change happening in a room in Washington. It splits your financial life into 2 very different stories, depending on who you are. Let's start with the one that affects your retirement account. Now, if your money is mostly sitting in a 401k, 401c, or an IRA, here's what this means for you. But if you're carrying a mortgage or thinking about buying, the math looks completely different, and I'll walk you through both. Let's start with the retirement side. Remember that GPS I mentioned, checking the forecast versus just stepping outside? For markets, just stepping outside means reacting to every single piece of data as it comes in, instead of trusting a roadmap the Fed already handed them. That creates what analysts call an uncertainty premium. One strategist at Evercore put it this way: Warsh seems to view a bit of market turbulence as a fair price to pay, if it means investors start forming their own view of where rates are headed, instead of just parroting back whatever the Fed implied. Another analyst framed it even more bluntly. We're heading back to the way things used to work decades ago, where markets react to the Fed, not the other way around. Now, I need to be very careful here, because this is where people get the story wrong. Retirement accounts did take a real hit earlier this year. Average 401k balances fell about 4% in the first quarter. That drop came from the Iran war and the oil shock that followed, not from anything the Fed did in June. What the June meeting adds isn't a crash. It's a different kind of weather going forward, more sensitivity to each new data point, because the old roadmap isn't there to smooth things out anymore. The VIX, which is basically the market's fear gauge, spiked to around 31 back in March. By mid-July, it had settled back down near 19. So we're not looking at panic. We're looking at a market that's a little more alert than it used to be, checking the window more often, because nobody's telling it what tomorrow looks like. If you're the kind of person who wants to weigh in on which side of this hits you harder, the retirement side or the mortgage side, drop it in the comments. It genuinely shapes what I cover next. Now, let's talk about the other side of this. Borrowers. If you don't have a mortgage locked in yet, or you're planning to refinance, this new approach changes something very practical for you. Think about it like driving through an intersection that used to have a traffic light. You'd see the signal from a block away. Red, green, plenty of time to adjust your speed. Now imagine that same intersection, except the light's been removed. No warning. You get to the crossing and you just decide, right there, in the moment. That's roughly what's happening to mortgage rates right now. Over 3 weeks in July, the 30-year fixed climbed from 6.43% to 6.49% to 6.55%, the highest it's been since August of last year. Freddie Mac's chief economist noted that purchase demand has cooled a bit, even as more homes are coming onto the market. But the analysts at NerdWallet made the point that matters most here. With less guidance coming out of the Fed, lenders can no longer lean on those signals to price in changes gradually. Rate moves are just going to be faster now. Less warning, less time to react. So if you're waiting for a sign that rates are about to move before you lock something in, that sign doesn't exist anymore. Not the way it used to. So both groups are living with more uncertainty now. But there's one more piece of this puzzle. A Supreme Court decision that happened less than 2 weeks after that FOMC meeting, and it tells us whether this new approach is here to stay. Now, if you caught my last video, you'll remember Governor Lisa Cook, fired by the president over allegations she denies, with the case headed to the Supreme Court. Back then, it was still an open question. It isn't anymore. On June 29th, 12 days after that FOMC meeting, the Supreme Court ruled 5-4. The court sided with Cook, not on some sweeping constitutional theory, on something narrower and honestly more useful for us. The court said Fed governors can't be removed without cause and without being given notice and a real chance to respond first. The president's attempt didn't follow that process, so Cook stays. Chief Justice Roberts wrote the opinion, and one line from it stuck with me. He said that accepting the government's argument would essentially turn a protected position into an at-will job, something he called out of step with how this country has always treated its central bank. Now, here's what makes this worth your attention, even if you've never thought about Supreme Court rulings in your life. The same day, in a different case, Trump versus Slaughter, the court let the president remove a commissioner from the FTC. Different agency, same president, same day, opposite outcome. That contrast tells you something important. The Fed isn't being treated like just another federal agency. The courts are drawing a line around it, saying, whatever else changes in Washington, this institution gets insulated from being reshaped on a president's whim. Now, I'll be straightforward with you. This isn't the end of the story. There's a footnote in the ruling that leaves the door open for another attempt, done the right way procedurally. And the president made clear on social media that he sees this as a technicality, not a defeat. So this may not be over. But here's what it confirms for our purposes today. This shift we've been talking about, the shorter statements, the vanishing forecasts, Warsh's whole approach, it isn't a fluke of one chairman's personality. It's happening inside an institution the courts just went out of their way to protect. Which tells you this new era of silence from the Fed isn't a phase, it's the new normal. Which brings us to the only question that actually matters. What do you actually do with that? So let's bring this back to where we started. Your mortgage rate and your 401k are behaving differently now because the thing that used to smooth both of them out, the Fed telling everyone what's coming, isn't there anymore. If you're the investor, the retirement saver, this isn't a moment to panic. It's a moment to actually look at your allocation, your risk tolerance, and ask whether it still fits a world with a slightly higher uncertainty premium built into it. If you're the borrower, the lesson is speed. Rate lock decisions need to happen faster now, because the warning window that used to exist is gone. And on the savings side, I'll just leave you with an update, not a lecture this time. The national average at big banks is still sitting around 0.38%. The best high-yield accounts are still paying somewhere between 4 and 5%. That gap hasn't closed. If anything, it's still sitting there, quietly, waiting for someone to notice it. The next real test of all this comes on July 29th. That meeting won't even include a new dot plot, which means even less to go on than usual. The first true test of a Fed that's decided to stop hinting. If you want to know what happens at that meeting, the first real test of this new approach, subscribing means you won't miss it. Take care of your finances. Nobody else will do it for you. If you want to keep going, I've got 2 more videos worth your time right there. Take your pick.